G'day everyone, James Walker here. If you are planning to pull the pin on work, hand in your resignation, and move into your retirement years over the next 12 months, I need you to pause everything right now. Grab a cuppa, sit down, and listen carefully. Because as of yesterday, the 1st of July 2026, the rules of retirement in Australia have been completely rewritten. We aren't talking about minor, superficial adjustments here. The Australian Taxation Office, the Department of Social Services, and Services Australia have rolled out a massive wave of structural updates. We are talking about brand new index contribution caps, a shifting general transfer balance cap, the controversial implementation of the Division 296 high balance tax, and a complete recalibration of the Centrelink means test thresholds. Now, I've spent the last 48 hours buried deep in government legislation tables, cross-referencing white papers from the ATO and Services Australia, just so I could clear up the absolute mountain of misinformation floating around online. If you've been watching other finance channels over the last few weeks, you've probably heard people celebrating that the age pension rate just went up. Let's bust that myth right out of the gate. That is completely wrong. The actual base payment amount you receive every fortnight did not change yesterday. Base rate indexation only happens twice a year, on the 20th of March and the 20th of September. What actually happened yesterday was an eligibility extension. The thresholds were adjusted. This means the goalposts have shifted in your favour. If Centrelink rejected your claim last month because you had a few $bucks too many in assets or income, the rules that took effect yesterday mean you might now suddenly qualify for a part pension and that gold dust pensioner concession card. Today we are going to dissect the forensic facts. No guesswork, no fluff. Just the exact numbers, the dates, the thresholds, and the hidden tax traps that could absolutely destroy your retirement cash flow if you aren't paying attention. Let's get stuck into it. Let's start with the massive superannuation cap upgrades. For years, the amount of money you could funnel into the low-tax environment of superannuation was tightly restricted. But due to broad wage indexation across the country, those limits have officially opened up as of the 1st of July 2026. First up, your concessional contribution cap. This is your before-tax money, including your employer's compulsory super guarantee contributions and any salary sacrifice arrangements you've set up, has officially jumped from $30,000 a year up to $32,500 per financial year. Think about why this matters to an incoming retiree. If you are in your final year of work and sitting in a higher tax bracket, you can now legally stash an extra $2,500 into super as a tax deduction. That money is taxed at just 15% inside your fund instead of your marginal personal income tax rate, which could easily be 30, 37, or even 45%. It's an immediate, legal tax saving handed to you by the indexation cycle. But the even bigger news for those about to retire is the change to the non-concessional contribution cap. This is your after-tax wealth, money you might have sitting in a standard bank account, proceeds from selling an investment property, or cash from an inheritance. As of yesterday, the annual non-concessional cap has risen from $120,000 to a brand new limit of $130,000 per financial year. And remember, because the annual cap went up, the legendary bring forward rule expanded along with it. If you meet the age requirements, which applies to anyone under 75 years of age, and your total super balance allows it, you can now bring forward up to 3 years of after-tax contributions in one single hit. That means you can legally inject a massive lump sum of $390,000 straight into your super fund this financial year. For a retirement couple who are both eligible, you are looking at the ability to shift $780,000 out of the harsh personal tax system and into the highly protected super environment in a single day. But hold your horses, because there is a massive catch here that the mainstream media completely glossed over this week. To use that $390,000 bring forward rule, your total super balance as of the 30th of June 2026 must have been strictly below the newly adjusted lifetime limits. If your balance is even one single dollar over the cutoff threshold, your non-concessional cap drops to exactly zero for the entire fiscal year. And if you accidentally transfer the money anyway, the taxman will hit you with severe excess contribution penalties. We will look closer at how to check your exact personal limits later, but for now, write those two numbers down: $32,500 before tax and $130,000 after tax. Now let's move to the ultimate goal for most retirees: moving your money from the working accumulation phase into the tax-free retirement pension phase. This is where the general transfer balance cap comes into play, and as of yesterday, it has officially climbed from $2 million to a new lifetime ceiling of $2,100,000. For anyone who has managed to build a substantial nest egg, This is a phenomenal upgrade. It means you can now transfer up to $2.1 million from your regular super account into a specialized account that pays you a retirement income stream where all investment earnings and all future withdrawals are 100% tax-free. If you are a couple, your combined capacity to hold entirely tax-free wealth in the retirement phase is now a whopping $4.2 million. But let me give you a very serious senior analyst warning about how the ATO operates this system, because this is where hundreds of new retirees trip up every single year. This $2.1 million limit is the general transfer balance cap. It applies fully to you only if you are starting your very first retirement pension phase account on or after the 1st of July 2026. If you have already transitioned partially into retirement before yesterday, even if you only moved a small portion of your wealth into an account-based pension a year or two ago, you do not get the new $2.1 million cap. Instead, the ATO calculates a highly complex proportional personal transfer balance cap specifically for you. They look at the highest percentage of the old cap you ever utilized and give you a proportional slice of the new indexation increase. If you assume you have a full $2.1 million limit when your personal cap is actually capped at $2.02 million because of a previous transaction, you will breach the rules. The ATO will identify the excess, force you to commute the extra funds back out into an accumulation account, and hit you with an excess transfer balance tax on the earnings. Before you make any major transfers this month, log into your personal MyGov account, navigate to the linked ATO portal, look under the Super tab, and find your exact, verified personal transfer balance cap. Do not guess this figure. While we are discussing large balances, we also have to address the elephant in the room that officially becomes active law for this financial year, the brand new Division 296 tax. If you have been fortunate enough to build a total superannuation balance that exceeds $3 million, you are now exposed to a 15% extra tax surcharge on the earnings linked to that excess amount. The real sting of the Division 296 tax, the part that is causing absolute outrage among self-managed super fund owners, is that it targets unrealized capital growth. If your fund holds a commercial property or a portfolio of blue chip shares that went up in value over the year, the government will calculate tax on that paper growth, even if you haven't sold the asset and don't have the cash on hand to pay it. If you are an incoming retiree with a balance anywhere near or above that $3 million mark, you need to ensure your fund has significant cash liquidity to handle these potential tax assessments without being forced to sell off property in a hurry. Let's look at the brand new workplace laws and income tax adjustments that came into effect yesterday, which are vital if you are transitioning out of work. The first major shift is the introduction of mandatory payday super. Up until the 30th of June, employers were legally allowed to hold on to your superannuation contributions and pay them into your fund in large lump sums on a quarterly basis. For an employee looking to retire, this was incredibly frustrating because your money sat in your employer's corporate bank account instead of compounding inside your super fund. As of yesterday, that loophole is completely closed. Employers are now legally obligated to deposit your superannuation contributions into your chosen fund within 7 business days of your regular payday. If you get paid weekly, your super goes in weekly. If you get paid fortnightly, your super goes in fortnightly. For new retirees wrapping up their final months of employment, this means your retirement fund will benefit from immediate, continuous compounding interest right up until your very last day on the clock. It also makes it much easier to track whether your boss is fully paid up before you hand in your final retirement paperwork. Simultaneously, the ATO has officially dropped the lower individual personal income tax bracket. The tax rate on individual earnings between $18,201 and $45,000 has been reduced from 16% down to 15%. While a 1% drop might not sound like a life-changing amount of money, it means that if you are working a part-time transition job or cashing out your accrued annual leave and long service leave entitlements this month as you retire, you will keep more of those hard-earned dollar bucks in your pocket rather than handing them over to the tax man. Now let's pivot to the core of our forensic research today, the brand new Centrelink asset test limits that went live yesterday. This is exactly where the eligibility goalposts have been moved further down the field, creating a massive opportunity for incoming retirees. Remember how the Centrelink asset test operates. Your primary family home, regardless of whether it is worth $800,000 or $4 million, is completely exempt from the assets test, provided you live in it. It is your non-home wealth, such as your super, bank accounts, cars, boats, and investment properties, that determines your pension eligibility. Once your assessable assets cross Centrelink's lower threshold, your fortnightly age, pension payment is cut by a brutal taper rate of $3 per fortnight for every single $1,000 you are over the limit. Let's look at the exact, verified figures that took effect yesterday, on the 1st of July 2026. If you're a single homeowner, you can now hold up to $333,000 in assessable assets and receive the absolute maximum single age pension payment of $1,200.90 per fortnight. That lower threshold has been indexed upward from $321,500. If your assets exceed $333,000, your pension begins to reduce under the taper rate until you hit the brand new part pension disqualifying cutoff of $733,500. That is up from the old limit of $722,000. That means if you had $730,000 in assets last month, Centrelink gave you absolutely nothing. Today, under the new rules, you are suddenly eligible for a part pension every single fortnight. If you are a single non-homeowner, perhaps you are renting or living with family, your asset allowance is significantly higher to compensate for not owning a home. You can now hold up to $600,000 for a full pension, and your part pension disqualifying cutoff has been pushed out to a massive $1 million and $500. Now let's look at couples. If you are a couple homeowner, your combined asset limit for a full pension has jumped up to $499,000. As long as your combined assessable assets are below that mark, you can claim the full combined maximum pension of $1,810.40 per fortnight. If your assets are higher, your pension scales down until you hit the brand new combined part pension cutoff of $1,102,500. This is a significant increase from the old ceiling of $1,085,000, opening up pension access to thousands of everyday Aussie couples who were previously locked out of the system. Finally, if you are a couple non-homeowner, your combined assets can now reach up to $766,000 for a maximum pension with a total disqualifying cutoff of $1,369,500. Take a moment to let those numbers sink in. If you are an incoming retiree planning your next move, these updated boundaries mean you can structure your wealth far more effectively without fear of instantly falling off the Centrelink cliff. Let's move to the brand new income test and deeming thresholds. While the asset test catches the majority of retirees, Centrelink always runs a parallel calculation under the income test, and you are paid whichever test results in the lower pension amount. Under the new July 2026 income test guidelines, a single retiree can earn up to $226 per fortnight before their pension is impacted. Every dollar you earn above that free area reduces your pension by 50 cents. The absolute disqualifying income cutoff for a single person is now $2,627.80 per fortnight. For a couple combined, the income-free area has increased to $396 per fortnight. Any income above that mark reduces your joint pension by 25 cents per dollar each. The final disqualifying combined income cutoff is now $4,016.80 per fortnight. And don't forget the work bonus. If you choose to keep doing a bit of consulting or casual work in retirement, the government allows you to earn up to $7,800 per year from active employment without a single cent of it counting toward that income test. But how does Centrelink calculate the income generated by your superannuation, shares, and bank accounts? They don't look at your actual bank statements or what dividends you were paid. Instead, they use a system called deeming, an assumed rate of return that the government decides your money is earning. As you know, the multi-year government deeming rate freeze officially ended a few months ago on the 20th of March 2026. The lower deeming rate jumped from 0.25% to 1.25%, and the upper deeming rate climbed from 2.25% to a significant 3.25%. This means Centrelink now assumes your money is working much harder, which can heavily suppress your part pension payments under the income test. However, yesterday morning, the thresholds where these deeming rates apply were indexed upward, offering some much-needed relief. If you are single, the first $66,800 of your financial assets is now deemed at that lower rate of 1.25%. Every single dollar you own above that $66,800 threshold is deemed at the higher rate of 3.25%. If you are a couple combined, the first $110,600 of your joint financial assets is deemed at 1.25%, and everything above that mark faces the 3.25% upper deeming rate. By pushing these thresholds out, the government has slightly reduced the total amount of phantom income Centrelink attributes to your savings, protecting your fortnightly pension cash flow. Now let's look closely at the common traps and mistakes that we are seeing new retirees make right now. With all these rules shifting simultaneously on the 1st of July, it is terrifyingly easy to make a catastrophic blunder that triggers an automatic ATO audit or an immediate Centrelink cancellation letter. Let's break down the 3 biggest traps you must avoid this month. The first trap is what I call the bring forward balance lockout. As I mentioned earlier, the after-tax contribution cap has expanded to $130,000, allowing a massive $390,000 3-year bring-forward injection. Let's look at a real-world scenario to show how dangerous this is. Take a guy like Graham from Bunbury, over in WA. Graham is 67, finishing up his final shift as a mining logistics coordinator this month. He has $350,000 sitting in personal savings outside of super, and his current superannuation balance is sitting at exactly $2,105,000. Graham hears about the new July 1st rules on the news, assumes he can use the expanded $390,000 bring forward cap, and transfers his entire $350,000 into his super fund on Monday morning. Here is the disaster. Because Graham's total super balance on the 30th of June was over the newly indexed $2.1 million transfer balance cap by just $5,000, his non-concessional contribution cap for this entire financial year was automatically locked out and set to exactly zero. By making that transfer, Graham has triggered a massive excess contribution breach. The ATO will hit him with severe tax penalties on those funds, and the financial impact could cost him thousands of dollars in unnecessary tax and accounting fees. The action step to avoid this is simple. Never make a large lump sum after-tax contribution to your super without logging into your MyGov portal first to verify your exact total super balance as of the 30th of June. If you are over the cap, you cannot use the bring forward rule. The second trap is the gifting excess trap. When everyday Aussies realize they are sitting just above the new July 1st asset limits, say a couple has $1,130,000 in assessable assets, which is just $27,500 over the new part pension cutoff, their immediate emotional reaction is often to give the excess cash away to their kids to help them buy a house or clear a mortgage, thinking it will instantly qualify them for the pension. This is a massive compliance trap. Centrelink enforces a strict, non-negotiable gifting limit of just $10,000 in a single financial year, or a maximum of $30,000 over a rolling 5-year period. If you give $50,000 to your daughter this month, Centrelink will apply what is called the deprived asset rule. They will take the $40,000 excess, treat it as if it is still sitting inside your bank account, include it in your asset test, and apply the 3.25% upper deeming rate to it under the income test for 5 full years. You won't have the cash. Your daughter will have spent it, and you will be completely locked out of the pension based on money you no longer own. Never gift assets away without calculating the 5-year Centrelink deprivation impact. The third trap is the personal transfer balance cap illusion. If you started a transition to retirement pension stream or an account-based pension prior to yesterday, you might look at the headlines and think, great, the cap is $2.1 million now. I can move an extra $100,000 into my tax-free pension account. As we established, your personal cap is locked and calculated proportionally by the ATO. If you overtransfer based on a headline you saw in the media, you are breaching federal law. Always look at your personal cap statement on MyGov, not the general figures reported on the news. If you need to get your retirement plan sorted under these new guidelines, write down these official contact points. For anything related to your personal contribution caps, your total super balance, or your personal transfer balance cap, you need to call the ATO Superannuation General Inquiries line on 131020. If you are ready to lodge your age pension application or need to update your asset register to reflect the new July 2026 limits, call the Centrelink Older Australians line on 132300. And here is my ultimate insider tip. When you call that Centrelink number, do not just speak to the standard customer service operator. Explicitly ask to book an appointment with a Financial Information Service Officer, the FIS team. This is a completely free, independent, and unbiased educational service provided by the government. An FIS officer cannot give you direct financial product advice, but they will sit down with you and map out exactly how these new July thresholds apply to your unique personal situation, completely free of charge. Look, the moral of the story today is that the transition into retirement this financial year is full of massive opportunities, but it is also a regulatory minefield. The brand new $32,500 concessional cap, the $130,000 non-concessional cap, the $2.1 million transfer balance cap, And the indexed Centrelink thresholds mean you have more flexibility than ever before. But only if you know your personal limits and execute your strategy with absolute forensic precision. If you found today's breakdown helpful, please hit that like button, subscribe to the channel, and share this video with anyone you know who is preparing to retire this year. We need to get these accurate numbers out there to protect our community from making costly mistakes. Drop a comment below and let me know. Are these new July thresholds going to help you secure a part pension this year? Or are you running into the $2.1 million super cap limit? Let's get the conversation started. I'm James Walker. Thanks for watching, and I'll see you in the next update. Next.